Today, Property Into the Depths, Part 2. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour and with a touch of philosophy on the side. This is a continuation of our series relating to property. And today we're going to do two things. Firstly, we're going to look at some more examples just to demonstrate what is really happening on the ground in a number of different places. And secondly, we're going to discuss specifically the potential returns from property investment. So to start, let's just remind you that on the 28th of July at 8 p.m. Sydney time, Edwin Almeida, our property insider, will be joining us for a live Q&A, and you can ask him a question live on the YouTube chat or send it through beforehand via the DFA blog. Edwin has always plenty of ideas about what's going on, and some of those ideas are a little controversial, so I think it'll be worth watching. And we're also going to discuss some recent property trends during the conversation. I thought I'd just share with you 2 or 3 properties that I've been looking at, thanks to Cookie Boy. It's very interesting looking in more detail at what is actually going on. All of this information is publicly available, by the way, so there's nothing proprietary about this at all. The first one I'm going to look at is a property in North Melbourne, Victoria, in postcode 3051. It's got 2 bedrooms, it's got 2 bathrooms, 2 garage places. And this was advertised by way of a virtual auction with a price of between $1.25 and $1.35 million. Well, that may or may not be good, but what's interesting is if you look at the sale price history, back in February 2017, it changed hands at $1.5 million. So before you start, you can see that since then, it's gone down in value rather than up in value, which of course goes counter to the official narrative about what's happened to home prices. And it's worth reflecting that 3051, according to our data set, includes a lot of properties with mortgage stress, so 37.5% of properties in that location are actually stressed property owners. In addition, 57.9% of households who are renting are in rental stress there, and worse still, 75.3% of property investors who live there are also under pressure. So put that together and you can begin to understand why it is that property prices are on the slide. Let's look at now Ascot up in Queensland. That's postcode 4007. And this is a property with 5 bedrooms, 4 bathrooms, 3 garages. Now, they're currently advertising it at $3.49 million. Which may or may not be good value, hard to tell. However, what is interesting that back in March 2010, it changed hands for $3.95 million. So you can see there that there has been no growth between then and now, and if that property were to change hands at 3.49, that is a loss. Now, if you look at the data, actually the mortgage stress is relatively benign at 20%. 1/3 of renters are in rental stress, but half of property investors living in the location are under stress. So that may explain some of the pressures that we're seeing there. But the fact of the matter is, again, this is an example of a property that has not gone up in value since 2010. And we'll just do one more. This is Waggaman in the Northern Territories, postcode 810. And this has 8 bedrooms, it's got 3 bathrooms and 8 car spaces. And it's currently being advertised for $519,000. And it last changed hands back in July 2015 for $615,000. And once again, the DFA data shows that in fact, mortgage stress and rental stress and investor stress is relatively contained, and yet prices are down, a long way down. And we're seeing this quite consistently across most of the Northern Territories at the moment, simply because of the supply-demand disequilibrium. And again, what I want to do is to underscore the fact that these three properties are all examples where prices have gone absolutely nowhere for the last few years. Now, I've had a few more people ask me about getting access to the DFA stress data. So we have data around mortgage stress, rental stress, and also investor stress. And in fact, you can go to the DFA Patreon channel, and here's the link, patreon.com/digital finance analytics. And in there is a subscription for the DFA Stress series, which is actually $50 US plus GST a month. So if you sign up for that, we will send you the latest data each month as we run our models. And that covers information to more than 2,000 postcodes across the country. It's the most comprehensive set of data on these topics currently available. Or, if you simply want a single postcode, send me a message via the DFA blog and I'll send it back to you. And if you want to make a donation to help, then you can. I'll send you some information on that when I respond. Now let me touch on the other issue for today, because there was an excellent article from Nucleus Wealth that spells out the true issues around property investment. So many investors actually have their heads in the sand on this, and in fact the net effect is that at current prices, finding scenarios where properties won't lose your money over 10 years is actually not that easy, which means that most buyers in today's market should be doing so as a lifestyle choice rather than an investment choice. And yet, if you speak to most people, they still assume that property can only ever go up and that property investment is a great investment. I'm sorry, it's just not true at the moment. Anyway, Nucleus started with the position that they were happy to walk away with no real profit after 10 years, but to at least have retained close to the initial capital they put in. And they used the brilliant Nucleus Wealth property calculator. Links are below for that. Now, they took a scenario with $100,000 saved for a deposit for a dream house available for $1 million. And they assumed that the banks were willing to lend the balance, which is actually no mean feat in the current environment. And they assumed it was for own occupation, so there are no negative gearing tax benefits, and the intention is to sell it after 10 years, just as a scenario. Now, using the property calculator and assuming a recovery from the COVID downturn, they chose the good economic conditions scenario. And here is the result. Whoops, well, the problem with good economic conditions is that interest rates will limit capital growth. And with 90% debt load on the transaction, the interest payments actually hurt. And it's worth noting that they used rent received as rent avoided in these scenarios. So now let's look at an even more optimistic scenario. So they chose property paradise conditions, which yields a higher return. But look at the underlying assumptions for that particular scenario. Now, while we're optimists, I have to say we need to be realistic. It's highly improbable that we're going to be able to lock in 2.75% for 10 years, nor is a 6% nominal rental growth year after year realistic. So let's try some more realistic assumptions. The first thing to note about the calculator is that by default, it is designed for property investors that tend to rent their property. Thus, as an owner-occupier, we can reduce the reinvestment in the property, let's say depreciation rates, those sorts of things, to $600, and also halving the repair assumptions. And they also dialed down the other costs. Now, the rental income should be viewed as money saved, not paying rent, so the variables about lost rent and vacancies can also be dialed down to zero. Now, once that's done, we come to the key assumption for the calculator and, of course, the investment outcome. What is my expectation for property prices? Investing in property implies we will have an expectation of property prices are going to recover over the next 10 years. This expectation of a property price rise can be incorporated into the calculation in a number of ways. You can do it by decreasing the gross rental yield, you can increase the mortgage cost relative to the wage ratio, or increase the property price relative to the wage ratio, or increasing the default setting of the mortgage cost compared with the rent ratio. Now, in the scenario that they chose, they decided to alter the ratio of mortgage costs to rent, as it's probably the easiest ratio to get a handle on. Data suggests, they say, this ratio is currently at about 134%, but the long-term graph suggests the 10-year average is closer to 160%. So they then assumed a post-COVID economic recovery and a resumption of immigration to drive property demand. So they took the view that the ratio should retrace towards its 10-year average of 160, and in fact they chose 148%, which is sort of a rough midpoint between the two values. With these key assumptions locked in, they then looked at the various economic levers, inflation, rental growth, mortgage rates, etc., to find a break-even investment. So now the question is, what economic expectation does this break-even result imply? Well, the inflation rate would need to be 2%. This is at the lower end of the RBA band of 2 to 3%, so not an unreasonable forecast over 10 years. But of course, inflation has been running nowhere near that for some time and is unlikely to for some time ahead. Rental growth needs to be around 2.5% or 0.5% real growth over a 10-year period. I guess that's possible. Given the slump in rents and lack of immigration, it's going to need to be in the second half of the decade, and it's going to have to be strong growth then. And lastly, they're going to need to pay an average, let's say, 4% mortgage rate over the 10 years, which, whilst that's historically low and unprecedented, it is at the moment quite feasible. A quick internet search shows that credit unions are offering a 10-year fixed rate that is not too far off that, so perhaps it could be an achievable goal. And next, as a good cross-check, using the compare rent versus buying function in the calculator, they confirm that we're near break-even, even with an assumed 0% return on that $100,000 over the period. And the calculator also highlights how the benefit of a geared property is mostly achieved at the tail end of the investment. So staying in the property for just 5 years will be about $60,000 worse off than if we rented for the same period, meaning that on the assumed property with stamp duty, mortgage, insurance and other entry costs, they'll be out of pocket by around $80,000 and add another $20,000 to sell the property on the other side of the transaction. And there you go, that's $100,000 gone. So we're relying on capital growth to make up the difference. Now, using the calculator, we can therefore find other scenarios that achieve break-even property results. For example, 1.5% inflation, 2% real rental growth, which means that I can then lock in a more obtainable 4.5% mortgage rate. Alternatively, a more aggressive property price forecast of, let's say, 160%, i.e. the 10-year average mortgage cost to rent ratio, means inflation could be 3%, rental growth of 3.5%, and my mortgage interest rate can now be a very achievable 5%. Now, armed with these baseline cases, a user can now test the sensitivities of these assumptions or explore their own expectations to assess the risks and benefits of various scenarios. But the net effect of all this is that at current prices, finding scenarios where property won't lose your money over 10 years is not that easy at all. Which of course then means that most buyers in today's market, if they were going to buy an investment property at the moment, should be doing it as a lifestyle choice, not as an investment vehicle. In fact, property investing, frankly, in the current environment, is a mug's game. And I think the Nucleus Wealth calculator just allows you to get below the surface and experiment with the different parameters. And I do recommend, if you are considering any sort of property transaction, whether it's owner occupation or investment, it's worth playing with the calculator. It's free, it's available on the web. It's worth looking at. And so in conclusion today, I want to make 2 points. The first is there is plenty of evidence about that properties are not going up. In fact, in many locations, they're going down. And secondly, the whole investment conundrum with regard to property investment is such that it is almost impossible to see how you can make returns if you were to invest in the property market at this stage. Now, if you'd invested years ago, then maybe, but it rather depends on where you invested and a whole bunch of other assumptions. But even so, if you run it forward from this point, you may well be looking at capital losses rather than capital gains. So, to conclude, you must understand that investing in property is not a lay-down-misere way to make superior returns, especially now. And in fact, all the data is pointing in the other direction. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.